Well, here's your window of opportunity.
State Bank of India presents ET Now Leaders of Tomorrow. Watch a brand new season at these times, only on ET Now.
A fitting Friday to a dizzy week on the Lal Street. The Nifty closes below 7,000 amidst heightened volatility. The Sensex is down over 6%, making it the worst week for Indian stock markets in over 6 years. A sharp rebound in oil prices gives equity markets a fillip. US crude rises as much as 7% after US consumer spending data shows improvement. Wall Street also looks set to open in the green as investors hunt for bargains in a battered market. Back home, it's a double whammy for the economy. Retail inflation inches higher for the month of January to come in at 5.6%, and December factory output slows down contracts by 1.3%. Finance Minister Arun Jaitley speaks for the first time this week after the market spirals down to a 21-month low, blames global cues and reiterates that Indian economy remains inherently firm, vows full support to PSU banks in the face of mounting bad loans. And in big earnings, Sun Pharma gains over 2% after the company's third quarter profit meets street estimates thanks to a high other income component and lower tax rates. Revenue grows 17% as expected by the market. Hi there, good evening. You've joined us right here on Smart Markets. I'm Tanya Bharadwaj in Mumbai. Also joining me on the show is every evening Ajay Sharma for a market perspective and Krishna Kumar for all the national developments. First, let's take a look at what really went down on the Lal Street today. A day of extreme choppiness really for us today, with stocks swinging between gains and losses. Let's pull up the intraday chart for you and you'll know exactly what we're talking about. After the carnage yesterday, as that graph tells you, we did end flat in the green, but by no means does that mean it was an easy today. It was in fact a day marred with heightened volatility. You had the Nifty even giving up that 6,900 mark intraday, but of course then managing just to end well above it actually. The Sensex also continuing to swing around that 23,000 mark. Some respite actually did come in for us, especially in the last lap of trade after you saw Europe indices turning positive. Remember, you've got markets in the rest of the world receiving a good fillip from what you're seeing oil prices do. US crude prices have risen something like 7%, not just after the UAE oil minister said that the OPEC was willing to talk with our exporters about cutting output, but also because on the consumer spending front, you've got some pretty encouraging data come out of the US, and that to some extent is really giving a good lift to things today. Take a look at US crude. It's up almost 7%. Brent crude also ticking nicely up in the green, almost 1.5% up. Wall Street also looks pretty set to open in the green, given that the handover from Europe is looking pretty robust. And of course, investors are going to be out there hunting for bargains in a pretty battered market. But speaking of battered, Ajay, what an ugly week it's really been. Cruel, if anything else, down 6%, the biggest weekly loss in 6 years. I think we can go on and on about just how bad it's been.
Well, that's correct, Tanya. In fact, just to compare, what we have lost this week, almost 6.5%, is something which we actually lost of an entire last series. So that series was looking bad. This time we've lost almost the same amount this week. So, you know, that last little recovery we are talking about because of European markets, we should not get deceived by it, because the short traders who have been making, almost swimming in money for the last entire week were covering their short positions and booking profits out of their short position. And that's why perhaps globally that's the kind of phenomena we are talking about. Remember, China opens for trade on Monday, and there's a lot of scare on the street. In fact, global strategists have also been talking that the chances are it may open gap down. So ahead of that, if I'm already making money in my short position, one would go out and cover. So that was something which played out. Earnings continue to remain extremely weak. And, it just ends there, because FII number remains a big sell, close to 400 crore. DIs have been buyers, but internals show that HNIs are liquidating big time, whether it's forced or not, because margin calls are coming. Bid caps are bleeding badly in today's session.
Okay, let's talk a little bit more then about what your strategy in a market like this should be, and more importantly, what are the factors that are going to be at play next week. Ajay, remember, was making that point about how you're going to see China come back online, so that's really going to be something that everybody's going to be looking out for. Let's chat then with two special guests who are joining in. We've got Mehrab Irani of Tata Investment Corporation, and Christopher Palmer also joins in from Benson Avenue Capital. Gentlemen, both of you, thanks so much for taking time out for us. Mehrab, I suppose the only strategy in a market like this is hope, wouldn't you say?
Yeah, good evening, Tanya. For anything in life, there is hope, and market surely represents that. However, on a more serious note, if we see, yes, the global factors are surely bad, but even if you see the local factors, they are not very encouraging at this point of time. If we see all the components of GDP, whether it is consumption, investment, government or net exports, every component is actually suffering. In the consumption, the rural consumption has been bad for almost 2 years now. The monsoon has been bad, and otherwise the demand has been very weak. Even urban consumption, even if we see lately a lot of the different data which is coming out, the FMCG sector volume growth, which is actually come down substantially. If we see a lot of discretionary spend has come down, if we see two-wheeler, that growth has come down, even it's negative for some time. So all that has also come down. Investment, there is actually no investment happening. Corporate credit growth is almost close to zero. All the projects most of the projects are stalled. The NPA problem is there in the banking system. The exports are also facing some kind of, I think, problem. Even the pharma sector, there also a lot of US FD, other problems have happened over the last few months. So overall, I think the climate is slightly worrying, and if you see, there is no pricing power in the manufacturing sector also. Today, the gap between the gross and between the GDP is hardly anything between nominal and the real GDP. So there is no pricing power, growth is not happening, and I think, yes, so these concerns are there at this point of time.
Right. Mehrab, in fact, let's break down that factor. I mean, you spoke about a lot of negatives. By now, they are well known, pretty well known, but the price continue to react on that. But now when today Nifty fell around the 6,900 mark, a lot of quality stocks rebound very sharply. For example, Kotak Mahindra Bank, HDFC Bank, Reliance Industries. I'm talking about large cap stocks which are getting beaten down, but their earnings are not really collapsing, or earnings profile has been much better than their peers in the sector. Do you think it is time that with 20% lower, the benchmarks have fallen, one should start readying the cash, at least, that if further fall comes, one should start or could start nibbling into some quality names?
Yes, Ajay, I would tend to agree with what you have said. If we see, already the markets have given a decent correction. Today, if we see, the valuations are almost 14 and a half times forward earnings, which are actually below the long-term averages. Now, the only question is when the earnings growth will happen, which at this point of time, we don't have an answer. But if we see, a lot of the large cap stocks in certain good sectors where with good managements and good business prospects are available at a very decent valuation. So I think our mind frame, which 3 months back had to be, from sell on all rally to just now, it has to be actually buy on all declines. So I think, yes, we have to be ready with our checks, and we have to be buying at every major fall.
Right. Or perhaps RTGS, actually. These days, all the big clients actually transfer money to their brokers via RTGS, isn't it? Right. But Chris, coming to the other big, point which is being discussed globally now is that the second rate hike by central bank, by the Fed, the chances are decreasing. In fact, the latest commentary also seemed to be suggesting that. What's your own estimate? What could be the likely timetable now in this current environment?
Well, I think the Fed was quite clear in their recent announcements, Yellen's testimony, for example, that she would like to raise rates. CPI is a target, and the labor market in the U.S. has tightened significantly. I think the global situation does push the likelihood of a rate hike in the second quarter down, but I would still say there's a 50% chance of a rate hike by the end of the second quarter.
Mehrab, historically, in fact, we were conducting some research during the day. What the data which threw up clearly indicates that past 4 bull-bear cycles, Indian markets tend to bottom out, in a worst-case scenario, 2008 was a 9 times 1 year forward. But area around the 11.5 to 12 times is something where we have rebounded very strongly. We are almost at 14 times now. Do you think we would go all the way to 11.5, 12, or perhaps at least a medium-term bottom could be made before that?
Yeah, Ajay, if we see long-term bear market bottoms in India have been made close to 10 P forward P ratios, and currently, and in many times, in most of the cases, the bear market bottoms are between 12 to 14 times price earning. Today, if we see, we are almost at around 14.5 time forward price to earning. Even the price to book value has come down to close to 2.1, 2.2 times. ROE is around 16.5%. Percentage. And if we also see the market cap to GDP, that is currently around 59%, and many times long-term bear markets were close to between 52 to 55%. So yes, in valuation terms, we are very maybe close to the bottom. The only question is when the earnings rebound will happen and when the revaluation will happen. But as far as the bottom is concerned, yes, we can maybe surely fall 5-10% from here also. But as I said, in this fall, we have to be more inclined towards buying into good stocks and good companies rather than selling into them.
Christopher, the other big cue, I think, for next week is going to be what China gets up to, given that, it's been away for this entire week and it's back online on Monday. To your mind, what are the risks emanating then out of that region right now?
The risks emanating out of China come almost entirely from China's domestic credit markets. There's a great deal of uncertainty out there about just how big China's bank lending problem and shadow banking lending problems really are. It can be argued, and certainly we've heard from the banks themselves in China, that their problems are not that great when you look at the level of reserves and precautionary reserves they've taken to offset any problems in their lending books. The problem is that poor lending practice in China goes a lot deeper than just the large commercial banks. There's a large shadow banking industry in China, and that industry, largely unregulated, is operating almost completely in the dark. And I think that's what spooked investors with regards to China, and they would like to see more action from the central government, not the People's Bank of China, but the central government of China, to come to grips with this problem.
Right, Mehrab, let me ask you the same question. Do you suspect that come Monday, when we have Shanghai sort of back in business, it's perhaps going to be a bloody start?
Maybe yes. The Chinese scare, I think, is for real. Today, if we see, China almost accounts for 25% of the global GDP, and if we see on an incremental basis, if we take the multiplier effect also, it is between close to 40-45%, and it accounts for major demand of all major commodities. And because of that, we are seeing all this problem which is happening in major commodities globally. So I don't think that we can just ignore the Chinese factor. However, at this point of time, I think as we are discussing, the valuations have come reasonable, and I think we might make a short-term bottom at this point of time. And for the next couple of weeks, people might start talking about the budget and the budgetary expectations from here on.
Mehrab, your thoughts on earnings this time around as well? Barring a clutch of few companies, specific names which did well, largely numbers have been disappointing. Do you see 2 to 3 quarter far out at least things change materially, or do you think it's anybody's guess?
Yeah, Ajay, if you see the earnings, yes, they were again disappointing. But I think when we went into this earnings season, the expectations are also very much pruned down. If you see the earnings for past few quarters, every quarter analysts were expecting almost 15-17% growth, which actually did not materialize. But this quarter, I think there were more realistic expectations. Although there was still a lot of disappointments. I think for the earnings to rebound, it will take at least a couple of more quarters, I think, because some sectors are still actually suffering. If we saw the PSU banking space, their earnings were even bad this quarter, and I don't think any respite is there even in next quarter. Also, certain other major sectors and stocks were also suffering. So I think, yes, the earnings have been at best mediocre, and I think there is no case for re-rating in the price-earning ratio at this point of time. So at best, I think the earnings might be maintained at least for next 1 or 2 quarters.
Chris, I'll let you have the last word, and these days it's very difficult, almost impossible to talk of global markets and local markets and not talk of oil. So what is your own estimate for crude oil prices from here, from these levels?
The outlook for oil remains very uncertain. There has been no sign of a cut in global production, and all of the factors which were playing towards a lower price last year remain in place. For example, people are driving less in big economies like the U.S., We're seeing more and more cities, particularly in the emerging markets, putting in place driving restrictions in big cities, and young people are driving less. So that's had a big effect on demand as well. So you've got no change in supply.